Why do we bother to make stock trades if beating the market is a fool's errand? Today on Escape the Clock, I'm speaking with a professional investor on this very paradox. We're going to get into the skepticism. According to the latest SPIVA scorecard, over a 15-year period, nearly 88% of all large cap active fund managers failed to outperform the S&P 500. So if the deck is mathematically stacked against us, why do we still treat investing like it's a skill that can be learned? We know that we need to protect our wealth and grow our capital, but the statistics suggest that trying to outsmart the system often leads to lower returns than just blindly buying into index funds. So on the show, we're going to dive into technical analysis and how it mitigates this problem, and that with a blueprint, it's possible to optimize returns. We're going to dive into the tips and tricks and how to actively invest without falling into the trap of following hot leads and hype. Stay tuned to learn the blueprint and how to invest like the pros. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. We have a saying around here, math over mythology. And when it comes to the stock market, the math can be heavy. According to the latest 2024 SPIVA scorecard, over a 15-year period, nearly 88% of all large cap active fund managers fail to outperform the S&P 500. If 88% of the professionals, people with Bloomberg terminals and massive research budgets, cannot beat the index, it forces us to ask a hard question. Is active investing just a fancy word for gambling? For most people, unfortunately, the answer is yes. We might be buying because of a headline or selling because of a feeling and call that investing. But my guest today argues that the reason retail investors fail isn't that the market is unbeatable. It's that they're showing up at a construction site without a blueprint. Josh Fuhr is the founder of Bison Blueprint. But before he was analyzing charts, he was optimizing supply chains in the healthcare industry. He spent his career finding inefficiencies in complex systems and fixing them. And when he turned that engineering mindset towards the stock market, he realized that successful trading isn't about predicting the future. It's about managing the present. Josh, welcome to Escape the Clock.
Thanks for having me.
Josh, excited to talk about this. We haven't actually dove deep into this subject on the show before, and I help people with investing. And normally there's a little bit of a fear about getting in there, and passive investing is really, enticing to people. I'd love you to think back a little bit though, and what got you kind of into this in the first place, and when did you realize there was a better way to get ahead rather than just buying index funds?
Yeah, so I was pretty similar to everybody else 5 years ago where, I had a investment advisor. I'm going there twice a year. They're updating me on the progress, and, we're doing 5 to 10% a year. I'm diversified in index funds and bonds and emerging markets, and, what that looks like, just over diversification. So about 5 years ago, when I started kind of dabbling in the trading world, I discovered that there was a different approach to this, to picking individual stocks. So I understand what it's like for retail investors to come from that perspective where, first you start out with an advisor, and then maybe if you want to self-manage, you're going to start looking at some index funds and things like that. And then people tend to kind of progress to this individual stock picking idea.
Right. Yeah. It makes me think about mutual funds because, basically, paying someone to manage those active picks. That's kind of like an index fund where someone's actively managing it. Again, I've covered this on the show. Anyone that's not completely familiar with index funds versus mutual funds, these are things can definitely look back. But, I realized I had a similar revelation as I was going through things. I started actively managing the stuff myself as well, because we have our own specific goals, and, we understand our risk tolerances better than any professional can. And we do try to communicate that. I think it might be interesting to go a little bit deeper though, and help the audience understand a bit more what active trading even is though, because at best, a lot of people might be thinking like the Wolf of Wall Street.
Yeah.
I think that's what a lot of people think of when they think of that type of investing. And that's actually not the reality of what it really is today. Tools have changed. It's more accessible than ever. So how would you describe it? And if you could touch on the differences between like day trading versus like swing trading and maybe even scalping, things like that, that would be useful.
Trading and investing is really like a spectrum. And on one far end of the extreme, you have things like scalping, and that's where you're looking for just minor differences in the stock price. You might hold something for a few seconds or a few minutes. Day trading is next up, where you're holding something for like a few minutes to maybe a few hours. Swing trading is after that, where you're holding something maybe for a few hours, but maybe you turn it into a couple days. The definition of swing trading kind of varies, where I don't think of it in that 1 or 2 day sense. I think of it more in a couple days to a couple weeks, even a couple months. So for me, that's what I consider swing trading. Um, and then there's another term called position trading, and that's kind of where I'm trying to move investors to, is where you're selecting stocks for something like 6 to 18 months, and you're cycling in and out of those as the price goes down, price goes up, you're buying the low, you're selling the high. And then on the other end of the spectrum, you just have long-term investing. And that's typically through quality companies like Apple and Nvidia and the S&P 500 and the QQQs. That whole world is definitely a spectrum from one extreme to the other.
Yeah, I'm excited to get deeper into your blueprint for that, because I think a lot of people will do a buy and hold position, which can be very long term, sometimes decades. But position trading is really interesting because it's looking at longer term trends, but not that long, right? You're looking at meta level. Maybe we can start with just day trading versus swing trading for a moment, though, since that's on the other side of the spectrum. There was this study from Cambridge University in 2023 that found that while day traders averaged a negative 3.8% return, swing traders were managing a positive 2.1% return. Now, that's not saying all swing traders are doing great, right? Actually, the data shows that trading more often is what gets you in trouble. The higher amount of transactions actually hurt your return. They don't help your return. Regardless, though, I was kind of curious how you see this with like trading apps and stuff now, gamifying experiences and making it easier than ever. Are people falling into the day trading side more than they should be?
I think so. And I think that there's a lot of young people that maybe are shut out of traditional careers that have turned to alternative things like this, especially young men that are getting into day trading. And it looks really glamorous. You follow an influencer on Instagram and they're in Miami, they have a Lamborghini, life is set. But it's really difficult. And Wall Street takes advantage of people that don't know what they're doing. And so I agree with those numbers that when I made the transition from day trading to swing trading into position trading, I became infinitely more successful. I am not actually that good of a day trader. And the analogy that I use is video games. I grew up playing video games, and day trading is really like a first-person shooter video game. Somebody pops around the corner, you have to shoot them. It's all quick reactions. It has nothing to do with strategy. Whereas the further you get towards swing trading, position trading, investing trading, it's about setting that strategy, finding the right entry, finding the right exit, managing your emotions, and it's not that quick reaction. So I agree that day trading is incredibly difficult. Very few people can be successful at it. And that's why I think that swing trading and position trading is really the right place to exist in.
Twitch trading. I think you just defined something new.
Yeah.
Yeah, that's a great analogy. I love that. I'm a gamer myself. We talked about that stat at the top about the SPIVA scorecards and how 60% of U.S. large cap funds fail to even beat the S&P 500 in a single year. That failure rate climbs to 90% in a 15-year horizon. So it's significant. I mean, when it comes to day trading, almost everybody seems to come out as a loser eventually. And so I guess it begs the question, if professional fund managers who have endless resources and knowledge to do this well can't consistently beat the index, what edge can any retail trader hope to have when it comes to day trading? Should everyone just avoid it, is what I'm wondering.
Yeah, so I've asked that same question about some of these big fund managers and not being able to outperform. And two things that stand out to me is there was a quote by Barack Obama that talked about, I think he was at the UN or one of those big meetings. And, he said, even in a room like that, these people are not as impressive as you might think. There's very unimpressive people that are at the very top of our society. And I think some of these fund managers fall into that same bucket. Obviously, there's some really great ones, Warren Buffett, Paul Tudor Jones, guys like that have just been killing it for years. And then I think a lot of these fund managers still fall into the narrative trading. I think that because they have to sell the investment to investors, they get stuck in the trap of having to find a good narrative. And so when I pick stocks, narrative is like third or fourth on my list of what's important to me. But if you, Daniel, are a billionaire and a fund manager comes to you and asks for $1 billion, you're probably going to ask, what are we investing in and why?
Right.
And the answer of, I like this line here on this graph, you might not be satisfied with that answer. So they fall into that trap of purely narrative investing. And I think that hurts them.
Yeah, absolutely. I mean, I noticed the people who are pitching to do it for me were really basically trying to sell me on let go of all control and trust me, I'll beat the market by some rate. Now, look, I mean, I've done fine beating the market myself, but I am putting good effort into it. I do think, though, a lot of people will see a lot of these finance pros selling courses and services left and right. I mean, it's so saturated right now with that kind of thing. My question to you is, with the S&P 500 returning really consistently historic highs, it was 24% in 2023, 25% in 2024, with a rising tide, all boats lift. So how can someone who doesn't really want to do this, who's a beginner, distinguish between someone who has an actual statistical edge and that actually is doing the real work versus someone who's just kind of benefiting from the rising tide of the stock market having these runs? Is there a way for someone to know the difference?
Yeah, that would be really tough because you'd really have to get under the hood there. But like you mentioned, pretty much anybody who put money into the Magnificent Seven the last 5 years is doing really well. Now, I think that run is starting to come to an end here soon. But that's, we kind of lived in this 5-year period since COVID where pretty much everybody won. The stock market went up, the Magnificent Seven went up. Everybody looked like a genius because they bought Nvidia or Apple. And the next 5 years are definitely not going to look like that. It's going to be more of a stock picker's market. So I would ask, what was their success like before the last 5 years? And what's their plan for the next 5? Because the market is all cycles. Stocks don't go up forever. Everything has kind of an end date to its cycle. But that's a tough question. Like, how do you get under the hood of that person's portfolio and see what they actually invested in?
Yeah, I think people just have to remind themselves, if something is too good to be true, it's too good to be true.
Yeah.
So you need to interrogate a little bit and educate yourself to ask at least some questions, get a second opinion, that type of thing. I love the point you just made, though. Like, the stock market are these sectors, and tech has really just run wild with this bull run, especially with these 7. And there's been fear about AI having saturated new volume of capital in the market, and that could pop at some point. So if the market does start to shift and it starts to become, now you really need to be looking across a much wider range of sectors. Maybe we can get a little bit into your approach and how you've been successful looking for trends. But first, before that, when people are looking, it's not just about buying, right? You're not just like, I'll buy this one. I like that stock ticker, blah, blah, blah. It does require setting up charts. If you're getting into this for real, you're reading candlestick patterns. You're trying to identify specific setups like a bull flag or things like that. And if you're not sure what those things are, there's plenty of great YouTube videos. You can start to learn some of these things. But my question is there a mechanical skill that anyone can learn with enough screen time? Or do people need to have a kind of specific skill set, like pattern recognition, intelligence, or something? Can anyone do this with enough time and training? Or does it really require a certain type of mindset to be able to be successful here?
Yeah, I think, the further you get into that scale of quick reaction. So when you come down from an investor to position trader to swing trader, you start to need more of that intelligence, pattern recognition, patience, emotional. There's a whole emotional side to this, the emotional stability to work through that. So as you work through those stages, those things become more and more important. But with things like position trading, it's actually quite easy to pick up and just kind of sit on your hands and wait for your target to get hit.
I would love to get into, if you think your background in logistics, which was kind of about precision and eliminating waste, what made you just naturally successful here, where other people like doctors, engineers, they struggle to do this. I came from engineering. I was a computer science. I worked at Google and Microsoft, places like that. I knew the smartest people, but they weren't managing their portfolios. They weren't figuring this stuff out. They'd pay to have someone else do it, but they weren't really getting ahead to the way that I was getting ahead. So I'm curious, like, did you have some kind of natural edge here where these other professionals aren't, or did something in your life happen that helped push you this direction?
Yeah, it's a little bit of both. I consider myself naturally intelligent. I love puzzles. I love patterns. I think one of the important things is being able to break free from that narrative. And that was a change that I had to make in the last 6 years. My approach, my perspective on the world has changed. And being able to like step away from what you're hearing on the news and like hearing Jim Cramer or somebody on CNBC say, "Hey, I like the stock," or seeing something posted on Instagram, here's 10 stocks that I like. And then being able to go look at that chart and actually doing that data, that research on the chart. Looking back at my career, I was always in optimization and I did a little bit with trends and big data. I would identify purchasing waste using like 5 years of purchasing data for a hospital. And so my ability to look at big data sets and identify trends and kind of look back on a couple years, and same thing with stock charts, is you always look back. What's happened the last 10 years? Where does price seem to bounce? Where does price seem to terminate? And so it's really like a big data approach. And like I said, you have to put that narrative stuff kind of in the back seat. It plays in, but so I think the biggest thing for people to learn this stuff is to be able to get away from that narrative thinking.
That makes a lot of sense. Yeah. I'll just talk about swing trading a little bit for a moment because that's the one I'm most familiar with. But, I can imagine like someone in the audience is trying to picture this a bit. And you could imagine if you had some data and you have that chart in front of you for some stock you're watching, you might be looking at the line because you have to look at the historical data. Like, how are you going to have be informed at all about, is this the right time to buy or sell if you have positions? And you might see the things gone up and down, up and down, up and down. And there's a trend line in there. You can find it.
Yeah.
And then you're at some point in time, and as long as you're able to look left on the chart, right? Look over what's happened. What patterns do I see? You can really infer, is this a low? Is this a high? Now, I'm not saying it's easy. I'm just saying that pattern recognition is a natural thing that people can do. We can perfect that skill the more we practice it. But what I've seen though, and the data shows this, is 80% of active traders will quit in 2 years. And it's not because they run out of money. It's because of the risk management factor. The losses were too painful. And losses suck. Like, no one wants to have losses, right?
Oh, yeah.
So I was curious in your journey, how much of your consistency, you've had wins, right? You wouldn't be here at this moment talking to us if you haven't had some wins. So how much of that came from you just being able to pick the right stocks versus knowing when to just sit back and ride and say, I'm just sitting on my hands here. I can't buy or sell at this moment.
Yeah, it requires a lot of patience, and you have to build that system of sitting on your hands. Like, there might be a green candle and you get FOMO, fear of missing out, and you think that the stock is going to take off without you. And then the next day it gets slammed down 20% and you're down 20% and you thought, I knew I shouldn't have done that. I knew I should have waited for that right price, and the market always gives it to you. So yeah, a lot of it is sitting back and waiting and not taking action. I only trade about an hour a day. And then maybe an hour a day, I'm in there kind of monitoring my positions just because that's what I enjoy. And then the rest of the day, I'm just surfing hundreds of charts, trying to find the next opportunity and basically saying, okay, I'll buy this company if it gets to $10. And I'll put a little alert there that if it gets down to $10, Schwab will send me a text and say, the stock is now $10. I'll go back and check it out. And that helps me avoid some of those emotional things where you just get so excited and you feel like this is the only stock in the world. If I don't invest in this stock, I'm going to be the only guy that's not making money. I have to get in on this. And that's just not the case.
Yeah, I want to ask you about your Bison Blueprint next. Before that, I will mention, since you were talking about that, It's such an emotional thing, right? What we're talking about here. And I think that's why people struggle with it. There is a sense of missing out. There's a sense of not wanting to realize a loss. There's been a lot of great psychology studied about this. I think for me, and you mentioned you do watches, I think that's really smart. I imagine that's kind of part of your blueprint. For me, I actually moved away from buying or just doing normal trading and just doing option trading because I realized, oh, okay, if I really want to buy this thing at a set price, I can make premium right now. I can get paid basically just to say I'm willing to be obligated to buy it at that price if it were to drop that low before the expiration. I'm doing cash secured puts and I'm able to acquire new shares, hundreds at a time per contract. And then if I acquire them, usually it's because I feel like I'm getting a discount on them. And now I can turn around, I can do a wheel strategy and I can start doing covered calls against them to generate more premium. But I'm in an early retirement situation. So for me, that's just part of my cash flow solution. I do it because I don't need to do it. I do it because it just provides extra cash flow for me. So I never feel forced to do anything uncomfortable or unnatural there. Watches are a powerful way to do it. If I'm not telling everyone to go to option strategies, by the way. I hope people aren't taking it that way. But maybe talk a little bit about how your strategy evolved and how you ended up landing on your blueprint.
Yeah. So as I made that transition away from day trading and into swing trading and kind of zooming out on the charts, going from 1 minute candles to 5 minute candles to 1 hour candles and backing all the way out to daily and weekly candles is really where I live now. Using shares, using high volatility stocks. I use a little bit of options these days, like at the money, long calls, things like that, just for a little bit of leverage.
Yeah.
But for anybody listening, that's a very, very scary place to be. Be careful. Know what you're doing before you get in there.
You can end up at a unlimited type of situation when it comes to putting leverage against it for sure.
Yeah. Yeah. Really ugly. But yeah, I think I just noticed that I was much more successful letting these things sit. And so as I zoomed out and kind of took that more strategic view of finding stocks that are sitting at their support level, looking for a trend line support or looking for a broken trend line. And over time, I just really did the data analysis on what are the 2 or 3 major things I'm looking for. And I made that the core of my checklist. And then I look for some additional confluences. So for people that are familiar with some of the indicators like MACD and RSI and divergences and those things, I created a checklist of kind of supporting factors. So I don't have to have all of them. I'd like to have a lot of them. But when the technical setup gives me an A+ reading, I don't even really think about the narrative. I don't jump into the company financials. I don't think about the narrative. It's really a technical play for me. And when those things line up, it helps. But that's how I kind of built my strategy with this confluence system.
How important is value versus momentum? Are you looking at if a stock's already a winner, or are you just looking at, hey, this would be a great affordability point for me?
Yeah, it really depends on your time horizon. So buying a stock that's at support, for the audience, support is a price that the stock does not want to break below. And it's typically a psychological number like $10 or $100. So anytime it comes down to that level, if you're a long-term investor and you're not trying to churn through this stuff really fast and make a bunch of money, the best thing I can recommend to you is to just buy at support. Buy at that $10 level, $11, $12, like in that zone. It's not always an exact number. But when you're like me and this is your profession and you start to optimize things, then you're starting to look for momentum, because a lot of times stocks can sit in our buy zone for months. If you look at the chart for PayPal and Square, they've been sitting in this box for like 3 to 4 years, and they've just been loading and loading and loading. And if you're a trader, that's going to really frustrate you. But as an investor, you're just kind of going sideways. Some of the other stuff you bought is winning, but eventually those names are going to take off. So as an investor, that's not as important. But as a trader, going sideways, you can't live off of that.
Do you have signals that help you filter out stocks that are healthy versus just experiencing hype?
Yeah, that's a good question. I think market cap is a good way to do that. Trying to avoid micro cap companies. I like to think of news events where, something that might happen is Tesla might have earnings and it says, oh, European orders are down 2% this quarter. And everybody starts freaking out. Is that the end of Tesla? Well, no, that's not existential for Tesla. That's not great. You'd like to see orders go up, but Tesla's never going to go away. Companies that I have on my watch list right now, Kraft Heinz, Newell Brands, some of these consumer brands, Kraft Heinz will never go away. Kraft Heinz is a massive company that sells half of the grocery store. So that stock is never going to go away. Now, some of the things that me as a really risky investor I get into, those might disappear tomorrow. I wouldn't recommend those to others, but for me, that's the litmus test I put things to is what are the chances this company just goes bankrupt this year? And that's almost always zero.
Do you also have like red flags you look for? Because I know you're probably watching some of these from quite a while, but do you ever like just disqualify one? You're like, okay, I was interested in this. No longer. Take it out of my screener.
Yeah, I do. I think sometimes it can be time-based where if it just sits there for too long, like a PayPal or a Square, where it's like, I've been burned. I thought it was going to go to the moon 2 or 3 times and I've gotten in and I've just sat there. So sometimes you have a time-based stop loss where it's just like, if this hasn't moved in a year, I'm done playing with this. We'll find something else. But for me, really, it's when support levels are significantly broken. So when price comes down to that $10 level and I make a purchase or I'm starting to get interested and it just breaks right through it and continues on, that signifies that something has changed, a change in character in that stock or in that company. And it does happen. And so when my biggest thing is when technical levels are significantly broken, that's when I say no to something.
A lot of people who have like looked at this before probably relate to this, but it can be quite easy to kind of get into an analysis paralysis situation where there's too many options. You don't even really understand what all of them are. You don't know which ones you need to pick but normally I think people who spend enough time with this, they start to realize there's a few high quality options that actually helps you get the signal you're looking for. Have you figured out what those are? Is those the things you're teaching? Or do you think it just kind of varies and you have to kind of learn them all like a toolkit and apply the right set depending on your goal?
Yeah, it really becomes a toolkit and a checklist. So, I have an actual checklist of these are the 3 things I will not even consider it, if it doesn't meet these 3. And then I start looking at that second level where I'm trying to put together additional confluences and additional confirmations. And there's some really cool stuff in there. Like I talked about the technical indicators, but things like insider buying. So you can find these insider transactions publicly. It's legal to do this. It's legal for them to buy. It's legal for us to follow them. And so if an insider is buying tens or hundreds of millions of dollars in a stock, they see something. They're kind of like doing that financial analysis for me much better than I can with much more access than I would ever have. And so if a stock is sitting at support and the CEO just bought $10 million worth and all my indicators are lining up, that's like a super green light for me. And so it's building that checklist. Same thing with hedge funds. Every quarter you can go check and see what they're buying. It's kind of on a delay, but they have to report the price. So if a hedge fund is loading up on something that you're interested in, that might make sense to take a look at. Like people that have more resources than you also like this stock. And if you're getting the right price and it fits your system, that's a really cool outside validation for you.
Those are great insights. I think a lot of what I'm hearing, and I hope others are hearing, is that when you realize there's some of these high fidelity, high value signals, especially when you're following people who have done a lot of research, who have inside information, you're going to benefit even better.
Yeah.
And you're not going and doing all that legwork yourself.
Yeah.
So that's powerful. I want to ask you this question, and I would love you to have a chance to let people know how to connect with you, because I think, a lot of people might be interested to learn from you in a lot more ways than this. I think we're just scraping the surface. But, we mentioned earlier, there's this trend of younger people looking to take control of their financial future. I've definitely seen a lot of this. I'm a bit encouraged by it, to be honest, but I'm a little worried as well, because the problem is where they're getting their information, how they're learning. And it's usually through apps like Robinhood, a lot of gamified things. And there's nothing wrong with that per se, but it does seem to encourage more trading because that's how they make their money. They make it through a lot of these transactions. And I don't imagine that's going to go away anytime soon. But if you could sit down with the new generation who are very hungry to learn some of these things, how would you help them shortcut some of the pain they're about to go through and kind of get closer to where you are today? How would you start to teach?
Yeah, the first thing I start with is showing people a chart. Most people have never seen a stock chart before. They've seen the line go across their Robinhood screen up and down, but that's totally different from a candlestick chart. And that's totally different from looking at things on a 10-year, 5-year, 1-year level and plotting those zones of interest. And so the first thing that I show people is this is what a stock chart looks like. And this is what support and resistance look like. Those are the two super basic things. If I had 15 minutes with somebody, I would say, pull up a 10-year chart, find where the price has always stopped, find on the top side and the bottom side, and mark those. And when the price gets there, become interested. When the price is in between those, you're kind of like flipping a coin. Is this bet going to be successful or not? But not to get too off track, the analogy that I use for proper investing is it's really like card counting in a casino. You're not going to win all the time, but when you know the count, when you're playing blackjack and you know the count and you have a count that's in your favor, that's when you make a bet. Card counters, they have to do silly stuff to kind of get the casino off their scent. But imagine that you can't get kicked out of the casino and you could just make a big bet when the count is absolutely in your favor. And that's what proper position trading and investing is making bets when you have that 80-20 advantage. And the whole story is told in that chart.
One follow-up to that, if they only had $100 instead of $10,000, would your advice change at all? Like number of candlesticks they should be looking at or how they're counting those cards? Would your advice change there? Or does it not really matter? You just need some capital and then go learn the basics and then get started.
Yeah, I think it really depends on your personal risk profile, your age, what that money means to you. If you're a young person and your risk tolerance is a 10 out of 10, I'd say you don't need to diversify. You can take a big risk on a single stock because you have to work your way out of that hole. But if you're 60 years old and you have a $5 million retirement that you are going to be dipping into soon, that's where you obviously need to diversify and protect yourself amongst 50 or 100 stocks so that you're not experiencing significant pain. But either way, the answers are all in the charts. And so if the chart tells you that it's a good investment, whatever you can afford, whatever you can put into that is a good idea.
Well, thank you so much, Josh. This has been very eye-opening, and I hope people realize this is just more education and more tools you have to trying to make sure that you're getting to your financial goals and hopefully that work optional life. How can the listeners connect with you and learn more about Bison Blueprint?
Yeah, so we're on all the social media, Instagram, Twitter, Facebook. Our handles are bison.blueprint on all of those. And then we have a Discord community where we're discussing stocks. I'm sharing my stock picks. You can find that either in the link in those bios or on the website whop.com. That's WHOP/Bison Blueprint. And if they use the code podcast50, they can get a 50% off their first month of the group. So in there, we're, like I said, sharing stock picks, explaining why, introducing people to charts, and people have the ability to reach out to me and say, hey, I own this stock. What do you think? Buy, sell, hold. So we're just constantly talking charts and what we like.
Amazing. Well, thanks again, Josh, for being on Escape the Clock. I appreciate it.
Yeah, thanks for having me.
In my conversation with Josh Fuhr, what jumped out to me was the sheer level of performance anxiety that we carry into the market. We often feel that we're failing if we aren't constantly moving. But the reality is that 88% of professional experts fail to actually beat the market over the long term. This suggests that the standard approach of following the hype and the Wolf of Wall Street narrative is a losing game from the start. In my entire lifetime, it never occurred to me that I was essentially playing a high-stakes video game with trading. I moved away from active trading years ago to focus on selling options for premium because I wanted more control. But I still felt that pull toward the action of the ticker. Josh explained that day trading is like a first-person shooter where you survive on twitch reactions and focus. By shifting to longer-term trading, you change the genre entirely to a strategy game, where you can actually use your brain to win. The solution is to stop looking at the simplified lines of a phone screen and actually pull up a real stock chart. With a real stock chart, you can look left at historical trend lines to determine your entry price. Instead of treating the market just like a standard luck-based casino, you actually approach it being able to count the cards and actually know when to make the bet when the cards are firmly in your favor. Did you notice how Josh downplayed the importance of company news and even their financials? He trusts the technical indicators over the hype, specifically looking for confluences like insider buying. A CEO does not buy tens of millions of dollars of their own stock unless they see a signal we can never have access to. And that is a golden scenario that we can actually follow. Josh has built a checklist to ensure he only takes trades when the data takes out the guesswork and the emotion. Ultimately, this turns your financial life into a logistics problem rather than an emotional one. It requires the patience to sit on your hands and wait for a forever company to hit a support level that has not been broken. By limiting your trading time and focusing on weekly candles, you move away from reacting to the FOMO to orchestrating a strategic win. I'd love to hear from you. How do you plan to filter out the market noise this week? Email your thoughts to contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thanks for listening, and best of luck investing like a pro and escaping the clock. I'll catch you next week.
Thanks for tuning in to this episode. Remember, while I'm not yet a financial planner, I am getting my degree in wealth management. You should take anything you've heard here as tips and advice to making your plan. To learn more, visit www.escapetheclock.com. There, you can find the book, resources, including the planner, and you can even schedule time with me. Please remember to like and subscribe so you don't miss an episode. Thanks for tuning in, and I'll catch you next time.